Welcome again to OnlyTax, where we give you the naked truth about how the tax system works. We're excited to be back with another episode of OnlyTax. Today, our favorite accountants are here again, Jason and Alyssa. We'll dive into a question we received from one of our subscribers. All right, so here's our question. This is a long one, Jason and Alyssa. Okay, here we go. I expect to qualify for real estate professional status, REPS, in 2026 and plan to leverage the marriage loophole to generate passive losses that can offset my wife's W-2 income as she is a surgeon. We're planning to invest approximately 500,000 to $1 million next year with the goal of sheltering a significant portion of her income. Our objective is to reduce the amount her employer withholds from her paycheck as early as possible in 2026 without triggering underpayment penalties, so we can deploy more capital sooner. The challenge is that the depreciation and losses we're counting on will be generated gradually throughout the year, not upfront. My understanding is that the IRS safe harbor rules may allow us to avoid penalties by paying either 110% of our 2025 total tax liability or 90% of our 2026 liability, even if actual taxes owed differ. Is this a sound strategy in our situation? And are there other approaches we should consider? What do you guys think?
Well, you know what? In practice, many clients do have this kind of situation and they significantly reduce or even eliminate W2 withholding once real estate losses are expected to offset that income. Well, if you're confident in your 2026 investment that it will generate sufficient losses, it's reasonable to reduce withholding accordingly. But you need to remember that the key is timing. Losses only count after properties are acquired and placed in service. So, accurate tracking, documentation, and REPs or material participation compliance throughout the year are very critical. When planned accordingly or correctly, this strategy can be very, very effective. Well, with that said, this should be done with a CPA who definitely specializes in real estate tax planning to ensure the assumptions, timing, and compliance all line up, especially if you're scaling quickly. Right, Jason?
Yes, as you said, you are 100% correct. It's all about timing here. And that's why it's very important to be working with a tax professional that is familiar with helping clients qualify for real estate professional. Also, you need to be making sure that you are meeting the qualification for the real estate professional, which is a 750 hours rules, that you're doing real estate activity, 500-hour rule for the material participation for your specific properties, and that you're spending about 51% of your time dedicated to real estate. And also, if you have multiple properties, making sure that you group those properties times that you are spending on those properties so that you can meet those qualifications much more easier. So once again, just like what Alisa was saying, as long as you are working with an experienced tax professional who has knowledge of working with real estate professionals, then you should be fine in meeting those qualifications, assuming that you are doing proper documentation to show what were the activities that you were working on for which property, what was the date, and how many hours did you set for those specific activities. Okay, so if you guys want a template of something that you can use for your logbook, please reach out to our team. We'd love to send you a free logbook that you can use to help track your real estate professional hours.
Thank you, Jason. Thank you, Alisa, for answering the question. Again, thank you so much for watching Only Tax, where we give you the naked truth about how the tax system works. If you have any other questions, don't worry, you can leave a comment and also check out our Facebook group, which is REI Tax Community. wherein we might answer your questions. Leave a comment and also check out our Facebook group, which is REI Tax Community, wherein we might answer your questions.
You know,